Hello everybody, this is Toni Turner and welcome to the market now as of about 10:30 a.m. Eastern on Friday, June 24th. U.S. stocks are off their lows, but they're still trading sharply lower today after the UK declared its intention to end its 4-decade relationship with the European Union. Investors are fretting that the unprecedented decision to leave the bloc could destabilize Europe's fragile union. The stunning move comes after global markets rallied yesterday on a bet that Britons would vote to reject Brexit, that as we know in the night, that didn't happen. Today the Dow dropped more than 500 points at the open, and at present the S&P 500 is down more than 2%. 9 of the 10 main sectors are trading sharply lower. Financials and technology have been leading the losses today. Also, to add to the fun today, the Russell 2000 and the 1000 indexes will be rebalanced, which may cause more volatility at today's close. And now with all that in mind, we're going to go forward and look at 3 stocks that could give us some insight into the week to come. First of all, as we usually do, we're going to look at our daily chart of the S&P 500 SPDR, symbol SPY. As you all know, this is the tracking stock or exchange-traded fund that closely follows our S&P 500 index. Now, we keep an eye on the S&P 500, or it's tradable, the SPY, because when the S&P 500 falls, that's our U.S. benchmark, more than about 4 out of 5 stocks will follow it lower. Of course, when it moves higher, about 3 out of 5 stocks will follow it higher. So it is a predictor that we look at, an indicator, if you will, that we keep an eye on to kind of see where possibly our portfolios are going to go. Now, this morning when the SPY opened, it gapped down. It gapped down to $203.63 right here at the bottom of this green candle. Admirably, it stayed above 203. It stayed above this price support at 203 and immediately began to fill the gap as traders who were short started covering, and as we call them, the buy the dippers came in. Of course, now at $205.88, as I captured this chart a few minutes ago, the SPY is moving higher. It now has resistance at the 50-day moving average, which is up at $208.09. Of course, it's also below the 20-day moving average. Now, our prior high back here, when things were looking pretty sweet, was on June 8th. We had a high of $212.52, or about $21.25 on the S&P 500 itself. It looked like it was going to head back up to the old highs at about $21.37 on the S&P, or $213 on the SPY. But since then, we've had kind of a rough roller coaster ride. We've gone down below the 50-day, then last week moved back up. This was yesterday's price action when everyone truly believed that the UK would stay in the Eurozone, and today was the reality check when it turned out that wasn't true. Now what I'm looking at is I want to make sure, for the sake of at least some of my portfolio, that the S&P 500 stays above its 200-day moving average. That black line here can act as important support. It comes in right now at $202.14. So I'm drawing that as our caution line, as the yellow line here. We want to make sure that the SPY stays above the black line, the 200-day moving average, and the yellow caution area here, again, which comes in at about $202. Should it fall below the 200-day moving average, should it fall down to the 200 area, of course that would be about 2,000 on the S&P 500. Yes, it could happen, but that will make me a lot more cautionary. That will make me look at things in a little different way, perhaps raise my stops on current positions, maybe even take some profits on some that I think where it's wise to do so. So we're kind of back down here in this yellow and red zone, at least for me, and something I'm going to keep an eye on in the coming week. So keep an eye on the SPY. Again, make sure, or let's keep our fingers crossed just for the sake of bull markets that it stays above the 200-day moving average. And it could actually bounce around here from, say, 203 up to maybe 211 during the summer months. Summer months are typically a little more languorous in the market as a lot of institutional traders head for the Hamptons. Now let's go on to our next chart. I'm doing something a little out of the ordinary today because it's an ordinary it's not an ordinary day at all. We're going to look at two ETFs that may be a place where you want to hang out a little bit this summer. I'm not advising that traders or investors move into these today. I think today could have a lot more volatility to come, but certainly places you can look at to maybe hang out for some of the summer months if you want to stay in. This is the Select Sector Spider Healthcare ETF. The XLV is the symbol. We've talked about it before. Top components in this are Johnson & Johnson, Pfizer, Merck, United Health, Bristol-Myers Squibb, and these kinds of stocks are the stocks that investors and traders typically go to when the market looks cranky and onerous, as it does today, and actually may look that way in the coming week, depending on what happens, maybe even a little longer. As we look at this today, we see that the XLV, along with everybody else, gapped down at the open, and it gapped down and it fell at the bottom of this green real body, we call it, green part of the candle, right down to its 200-day moving average, the black line on this chart, which actually this offers indicator support and offers price support right down here in this zone at 69. So it gapped down to 69.37, landed on its 200-day moving average, then used it for support so far anyway. At the moment I captured this chart, it was trading at $70.34. Overhead resistance could lie at the 50-day moving average at about 70.70, but as this line is moving slightly up, horizontally to up, I don't think it will cause much resistance should the XLV power up. The RSI here is totally neutral. The MACD is down at its zero line. So all I'm thinking is, in the coming week, perhaps not today, but in the coming week, if the XLV can stay above its 200-day moving average, if it can stay above $69 here, I would look at it as a potential place to maybe hang out for a couple of the summer months, again, as long as it can stay above its 200-day line at $69 and change. Should it go below that, I will no longer be interested. Okay, our next chart for the day is the Select Sector Consumer Staples ETF. The XLP is the symbol. As you can imagine, staples are another place that investors like to hang out when things get dicey. And as our market was pretty dicey for the last quarter, you can see that staples actually held up very, very well. Top components in this ETF are Procter & Gamble, Coca-Cola, Philip Morris, Walmart, CVS, those are the drugstores. This is a place, again, that you may want to look at to hang out, but again, I wouldn't be opening a lot of new positions today. That's just my personal opinion, as I think there's more to come in the market. But if consumer staples, the XLP, can stay above 53, it actually found support on its 50-day moving average, gapped down to price support just a little over 53, and down to its 50-day moving average, and then bounced as people looked for what they consider to be safe. The XLV I showed you before, that pays dividends. The XLP pays dividends. People are looking for yield right now, so that's one added attraction to these funds. If the XLP, which was at 53.72 when I captured it, If it can stay above $53, I might look at it next week as a place to hang out, as I said, if the market stays cranky. The caution line for me here is down below 53. Now, I know some of you are long-term investors, and you may say, Toni, I can handle a little more risk than that. Where I don't want to go is I don't want to be in it. It has supported about 51.75. That's price support at these two lows. I put our red zone down below that because should the XLP fall below 51.75, should it fall below these prior lows, then for sure I don't want it anymore as a long position. So maybe it bounces around this summer between 52 and say 54.50. Maybe it does that. Of course, that's just a big guess. I certainly don't know for sure. But you may want to keep an eye on the XLP, especially if it stays above $53 going into the coming weeks. Okay, now we'll go on to next week's economic reports. But first, please join us for Toni's Market Club this coming Monday online from 4:30 to 6 p.m. Eastern. We're going to have a lot to talk about, a lot to look at, and a lot of big opportunities in front of us. We'll talk about which side of the market to trade, have a mini trading lesson, and I'll give you stocks and ETFs that may become ripe for high potential trades. This is a low-priced, high-value opportunity to make more money, learn more about the market, and become a smarter trader. So please join us. For those who cannot attend our live session, no problem. The recording of our session is available a few minutes after the session ends. And now for the coming week's economic reports. Not much going on Monday. Tuesday, we have the GDP, the third estimate. We have the Case-Shiller 20-City Real Estate Index and consumer confidence. Can't wait to hear what that looks like. Wednesday, we have PCE core prices, pending home sales, and our weekly crude inventories. Thursday, we have our weekly jobless claims, new home sales, and weekly nat gas inventories. On Friday, not much going on the economic reports front. Again, join us for Toni's Market Club this coming Monday. Don't miss out on this fantastic opportunity to raise your trading knowledge and your trading profits. Until next week, keep green on your screen. I'm Toni Turner, and this is the Market Now.